Hi, everybody. Welcome back to the Comstock channel. I'm Marlin Bohling with you. I'm joined by Joe Camp of Comstock Investments, and we're going to take a look at the markets at midweek, see what happened in the market trade, what the market is looking forward to, and we'll analyze all kinds of things that could be impacting our commodity trade. Be sure to like this video and share this video with others as well. And make sure you subscribe. You can hit that bell icon on there and be notified when we post new updates. All right, Joe, when we look at the markets on Wednesday, not a pretty picture on the grain side. And I guess maybe we should get the ugliest news out of the way first. And that would seem to be the wheat market. This is one of those days where I guess from my own perspective, I'm glad I don't have to look at the wheat market as being a producer today, because it's getting hard to stomach.
Yeah, wheat is the weak link all around here. You'd think that we'd have further upside, some of that additional short covering, some seasonal upside starting to develop here for the broader grain market, if not for this latest leg lower for wheat prices. And again, it's something that derives from international export prices, namely those out of Russia and France, some top competitors of ours there. We're seeing that Russian prices, they're the lowest of the bunch now, testing just below $200 per metric ton. You've got France, they're just barely above $200 a ton. You've got a big spread under those offers compared to where we're at, as much as $2 a bushel in some cases for hard red wheat. We have a graphic to track that from the International Grains Council, something I'm looking at just as a general basis of what's going on. And you can see the huge spread from the U.S. over France, and Russia would be down there again, just right at or below $200 per metric ton. Maybe that's a point of support eventually here for the broader market. But for now, yep, it's wheat that's the anchor today for sure.
So how does that work? How are they able to undercut us by that much? I mean, are they subsidizing their price, or how do they get by with that?
In Russia's case, it's just a matter of having such a surplus built up from these last two huge crops, and it being a factor of them needing to push this crop out and to try to generate, for one, hard currency. That's something that they're going to need as long as they're going to press on with this war in Ukraine. But you have, just generally speaking, a lot of extra wheat surplus being built up in that region. Similar story for France as of late. We could maybe see a smaller crop ahead generally across Europe. But just the time of the season, we've opened up this huge spread. And in part, it's been that we've been more optimistic lately in the U.S. futures market of what's ahead, of that potentially we'd need to account for one, continued strong demand relatively for soft red wheat in the Chicago market. Two, for weather risks that could still pop up, and for lower supply maybe being produced on the hard red winter wheat crop for the Kansas City futures. But anytime you've got these international values going lower like they have been, we see an opportunity or a point at which the U.S. market has to correct lower, and converging downward it is right now.
Well, and looking at the U.S. production potential for this year for hard wheat or winter wheat, I mean, it looks like we got off to a pretty decent start. And I know there are some dry pockets kind of emerging once again, but overall, once you get that wheat growth early in the fall and through the winter, I mean, it's kind of hard to keep it from not making a crop after that.
Yeah, good start generally speaking. We did have softer acreage down into the southern plains. We've got, as you mentioned, a lot of improvement, particularly in that region here these last couple of months. But then all of a sudden, some reversal of that. So we'll still have to keep an eye out on that. I mean, this is the same region where we're monitoring that huge wildfire in the Texas Panhandle, and really heavy dry winds up into Oklahoma and Kansas. So there can still be a period here as that crop continues to come out of dormancy and develop and mature where you could have yield impacted for sure. We'll start to monitor condition ratings here on a more regular basis. We will likely have a good amount of wheat here, to add, but nothing to say that we're necessarily growing in a big way inventories on last year, unlike some of these international countries we just talked about.
So do you think wheat is acting like an anchor around the neck of the corn market right now?
Yeah, I think certainly it is. That you had relative strength for corn today, despite the double-digit losses here over the last couple days for the wheat futures. You had corn popping up and eventually settling higher for the session. So it's trying to get past that. You'd have the feeling that if it weren't for wheat going lower like it has been, that you'd have a continuation in a bigger way of some of this short covering that we've recently observed. Now, there's nothing overly bullish about the corn market that we can talk about at the moment, and there's still a lot of room left on the chart before we would break this downtrend that we've been in for some time now. But it's lately an easing of the bearishness, and we can't say that unfortunately for the wheat at this point.
I know on the corn, a lot of people, myself included, were looking at the end of February and hoping that maybe that would break that downtrending pattern that we were in. Everybody was optimistic about the 1st of March and that maybe it would make a turn in the market. I'm looking at a corn chart here, and it looks like that was only worth a few days of small gains. And is that it? I mean, surely
Right.
there's got to be better times, doesn't there?
Yeah, it is something, though, that we did get past first notice day. And last week, having 4 up days in a row, we certainly hadn't enjoyed that for some time. But we broke hard to close the week and then started off, kind of tepidly here. Again, to see the strength at the close is something. Yeah, we can bring up that corn chart and see that it's a long ways. We maybe have to get up to 450 or 460, some 20 to 30 cents from here, which would be a considerable rally to even start to test that downtrend that we've been in. But it's something, again, that we've just not continued to go lower, right? Now that we're out of February, it has the time of the season encouraged some short covering. We watched that open interest initially decline as some of those bearish hedge funds closed at least a part of their record net short position that they'd built up in corn. But again, short covering and an easing of the bearishness is one thing. As we keep saying, it's another to have sustained upside traction, and we don't have that yet. And as mentioned, we're not going to have it if we continue to slide lower for wheat. So that's the first issue we need to watch for.
In Brazil, the Safrina corn crop still has quite a ways to go. Could have some weather impact yet, couldn't we there?
Yeah, that's one thing I was just looking at was the precipitation anomaly map for the last 30 days across South America. And we can see, across the majority of Brazil that you're in the red and yellow, huge deficits from what they would normally have at this point of the year. They're entrenched in a dry spell. It's been that way for a long time. They had some showers that, improved seeding prospects and helped finish some of the later type of soybean crops in areas of Brazil. But we're getting into a point of the season for that second Safrina crop where there is likely going to be further damage on yield prospects here, and something we're going to have to account for in future reports. Not just the soybeans that still need to go lower in terms of the USDA estimates, but also the total corn production outlook. And that's something that, we're not just watching as Chicago traders, but also something that the big importers like China would be keeping an eye out for. If they see risk that there's going to be tighter availability of Brazilian corn here, they're going to potentially hedge their bets by buying more from the U.S.
But even if they would have weather problems with the Safrina crop, and it would turn out to be just kind of mild problems, I mean, aren't we still looking at the prospect of a $2 billion carryout on corn anyway?
Yeah, that's still where we're at on the U.S. balance sheet. It's a matter of how fast it's going to come out. We saw some of that farmer selling at the end of last month. Generally speaking, they've tightened up again, even in the face of really favorable conditions and the willingness to want to move it. We see basis strengthening to signal there's that demand out there, even relative to a big carryout estimate. And similarly for Brazil, as they put a new harvest into the pipeline, it can also be the case that prices bottom out in a way where we maintain, the U.S. does, a favorable price advantage under Brazil that would attract some of that interest from the buyers like China. It doesn't have to be as much as it has been in years past, but it would be an additional source of trade demand for corn that would add to what have quietly already been very strong exports on corn, namely to those key buyers that we've relied on: Mexico and Japan, Colombia, a top 3 importer of U.S. corn this year. So Chinese buying would be sort of at the margin a pretty bullish addition. And it would certainly be something, too, that would grab the headlines. If it's anything like last March, we had nearly every other day, actually more than every other day, I think 14 out of the 23 trading sessions last March, we had an announcement for a flash sale of U.S. corn, pretty much all of those to China. Not likely to have that this year, but if we have anything close to a resurgence of demand from China, that's going to maybe be what those hedge funds need to cover some additional shorts.
Well, we can hope anyway. What are they, like half done on soybean harvest?
Yes, they're moving past the halfway mark here. That can, help some of the harvest pressure ease. It's still the issue, unlike corn, where we maintain a pretty favorable position for prices relative to Brazil. It's still the case that U.S. soybean export offers are a lot higher than what we're seeing out of Brazil. But it's the time of the year anyway where we shift the focus away from the soybean export program. There's not a lot of soybeans left out there to be exporting, right? We're talking more about importers in the southeast U.S. taking actually some beans still from Brazil. And so I don't think that's the biggest issue, that we're maintaining that price disadvantage at the moment for soybeans. We've already put quite a bit of that crop out into the world trade channel, but something we can observe in terms of still lower estimates to come for the Brazilian soybean export estimate. And that'd be, maybe something that the trade would be more sensitive speculatively if we start to see that as soon as this coming Friday with the crop report.
And looking at a chart, they haven't broken out of their downtrend line either yet, kind of like corn. What do you expect to see then on the WASDE report this Friday as it relates to corn and soybean?
Usually a pretty quiet one. What we think would be kind of one of the last quiet reports here before we get really busy into a forward focus for the new crop year. But we don't have any of those next crop year estimates baked into the U.S. balance sheets here coming up for this Friday's March WASDE report. Instead, it'll be a focus that's trained on those South American estimates. The trade looking for the Brazilian soybean crop to decline about 3.5 million tons from last month. Corn down just more than 3 million tons. So that's a sizable enough reduction. It would still be above where most folks are at in terms of private estimates for Brazil, but it'd be a step in the right direction. Could be setting ourselves up for, though, even thinking that the USDA would cut by that much, just knowing their track record of being conservative, or in my mind, sort of stubbornly high. But that'll be our next opportunity, again, because there's been so much advancement since last month for the Brazilian harvest. They should have a better handle on that, and that could help. Anything it feels like, because it's more of a quiet crop report, anything that's just not bearish would allow us to probably resume this more technical type of seasonal trade that we've been in here this last couple of weeks.
So the livestock trade seemed to be pretty quiet here on a Wednesday. And, looking at a live cattle chart, I don't know. I mean, it looks like maybe it's trying to make a little tiny head and shoulders top, but I don't know if you're getting much in the way of technical signals out of that market or not.
Yeah, a bit of consolidation just generally. We've had such an impressive run up, really. I mean, $23, $24 up from the December lows for nearby live cattle, within, $10 of those December all-time highs. It's the opposite. We keep thinking of what we've talked about for the grains, whereas those hedge funds had been so short that market. Well, over the last 2 months, they've been really aggressively bullish in the livestock. And so it gets to a point where they've realized gains enough that they want to step out and close some of those positions. And that's the flip side of it. Short covering for grains, long liquidation for the livestock. That's in part why we've started to consolidate. If those traders see further deterioration out of what could potentially be a head and shoulders type pattern or a break generally of this uptrend, as we would just even roughly defined by the 20-day moving average, which we were testing on a lot of these contracts today, then you could see further selling from here. But fundamentally, cash market seems to be holding up this week on last week. We're optimistic about prices responding to tight fed cattle supplies and solid demand. It's more of a technical move than anything, I think, right now.
Feeders have definitely turned sideways, the way it looks on the chart, kind of flattening out here about the last week or so. From what I understand, it seems like there is a lot of increasing LRP interest in our office. And I wondered if you could comment on that for a second.
Yeah, there is a lot more talk about how do we use these products that are subsidized in part by the government to help us manage risk, just like we're thinking about crop insurance ahead of the March 15th deadlines. This is something where when you've had such strength in the cattle market over these last 9 to 18 months, even, we've been back and forth, but generally just coming off of those all-time highs, it's going to make sense to think about how do you protect these potential profit opportunities. And LRP is one way that we see our cattle producers doing that. And so anytime you can talk to somebody about managing risk or potentially locking in a profit here on these higher values, that's something that comes into play and that we would encourage the conversation on.
Do you think that is something that is underutilized, that maybe if people had questions about that, they should maybe contact our office?
Yeah, we've got the experts here that are licensed to have conversations about LRP, and it is something that could have been underutilized in the past, at least relative to, again, what we've seen lately, which is a real uptick in probably usage, but definitely an uptick in research and a desire to understand what's out there for that product.
Yeah, you hate to see these prices slip away and not take advantage of them, that's for sure. How about hogs? Where are we now in the technical pattern there?
Yeah, somewhat similar to cattle. We did not, stop short of the all-time highs like we did on cattle. We actually had maybe a more considerable rebound here over these last 3 to 4 weeks. You see these summer contracts topping $100 on the board. You get a little bit of technical resistance on that standpoint and some selling from the hedgers that are wanting to lock in forward profits if they can manage them. You see, though, that the upside run is being taken note of, and that would fit with what we talked about with cattle. It's been 6 or 7 weeks straight that the hedge funds have been marked as net buyers of the hogs. And if you get a little bit of a whiff of a correction, you're going to see those type of traders want to exit the market. Like cattle, fundamentally going forward, we can't be too bearish about the outlook because of what we see as far as tightening supply into the summer months and beyond. It had been a case of abundant supply weighing on the market. But then those lower prices, something that the producers have responded to with lower farrowing intentions of stepping out and ultimately planning to tighten up production here going forward, which is their, from here friendly.
Yeah, well, if our viewers out there want more information, maybe you can throw your phone number out there and they can give you a buzz, and they probably have some questions I hadn't thought of. But how would our viewers get in touch with you?
Yeah, my phone number, 712-227-1095. Of course, my email, my phone number's there on our website, comstock.com as well.
Awesome. All right. Well, sorry I didn't get to talk with you last week. Maybe we'll get you at our next trade show, and folks can talk with you directly there too. But I appreciate the help. Have a good rest of the day. Joe Camp with us. He is with Comstock Investments. That'll do it for this episode. Appreciate you joining us. Well, for producer Brianne Hendrickson, I'm Marlin Bohling. Catch you next time on the Comstock channel. Thanks for joining us on our Comstock YouTube channel. Don't forget, you can also find us on Facebook and TikTok as well.